installment of EverGuide Financial's educational videos. Last time we talked about Apple and the income statement. We actually went through and did an example of how to get the information and download it to Excel so that you're actually able to manipulate the data. If you need help doing this, please look at the previous video on the income statement. But for today's review, we're actually just going to get right into the Excel. So the reason balance sheet actually might be one of the most important financial components to look at. And the reason why is it shows how much a company owes and the ability of a company to meet its obligations and fund its operations. And again, the reason why this is very, very important is because as the business cycle goes through, you're going to have ups and downs for every company. Every company is going to have ups and downs. And the ability of a company to survive the downs is really derived from the balance sheet, because it shows, one, how likely it is for a company to go bankrupt, and then also if it can continue to meet its obligations. So additionally, even if there's not necessarily a high risk of bankruptcy, a bad balance sheet can hinder growth of the company and also growth in dividends or cash flow of the company going forward if they have to continually pay debt. So one of the things that we did last time on the income statement was we did common size. So it allows, not only does it take the numbers, but it allows you to go in and look at percentages. And one of the things that's important, and again, we did the same thing here on the balance sheet. So here, these are all the current assets. These are the total non-current assets down here. So what I did was I went in and I just divided the cash divided by total assets to get a percentage. So it allows you to see, really from 2014 to 2020, it allows you to see what that cash looks like. So what's interesting here, and again, what's important by looking at these at a balance sheet or an income statement or a cash flow statement is it allows you to pick out something, either trends or also anomalies, something that's different. So there's a couple of things to notice here, especially when it comes to cash. One is 13% in 2016 is a very, very high cash level relative to assets. So something in 2016 happened. Most likely that could have been, so you can have cash from either raising debt or raising equity. Something happened there where there was a big cash infusion. So it's one of the things you want to possibly go back and look at and say what happened in 2016 caused that big cash infusion. Then what's also interesting is you can see that cash number is very, very high, 5%, 1%, 1%, now down to 0.59%. So cash has dropped. And what does that tell you? That tells you that there needs to be something done to raise those cash levels for Walgreens at this point in time. That can either be through issuing debt, that could be selling off something, maybe a non-performing asset or something that doesn't quite work with your overall long-term strategy. You could issue new shares of stock, or maybe your business just starts operating better. There's a lot of things that you can do, but looking at this trend, you can see it's obviously going down, and something must happen. Next, you can see accounts receivable. This is actually pretty consistent over time. It gets a little bit higher, but it's between 8 and 9%. You had a higher one in 2019, but then again, 8% here. And then now you've got inventories as well. Started out at 16%, and that's dropped down. It was pretty consistent, 12, 13, 14 level, and then down to 11%. So you can see actually inventories are pretty low. One of the things that I will bring up, 2020, this is something to really pay attention to, because obviously with the global pandemic, businesses were affected pretty significantly. So this will take a little bit more work to go in and say, maybe this cash level is not necessarily as low as it should be. Inventory levels are low as well. You probably want to go in and look and see, if that's something that's one-off for this year or if it's a trend. And so it really goes down to looking at what's available. now we'll go down here. So current assets, that's just the overall level relative to total assets, and obviously you can see that's come down quite significantly from the 30% down to 20%. Next, we'll go to property, plant, and equipment, and this is obviously what's in the building, and you can see here too, this has gone from 33% down to 15%. What's interesting, and again, I'm probably going to jump ahead here, but property, plant, and equipment dropped down to 15%, and you can see in 2020 there was 25% is in operating leases. So you probably can figure out, and again, you have to go and confirm with the company, but what my guess is something happened where they probably sold some buildings and then leased them back. So where maybe some of their buildings were they held the real estate, now they're actually leasing this real estate. And so it's one thing, again, I don't know 100% right now, but it's one thing to look at. You probably want to go look at with the company. So next, here's an equity investment in another company. You can see that that's a little bit more in depth, so we're not going to talk about that right now. Goodwill and intangible assets. This is just something to look at, because one of the things that happens with these is usually it's from some type of acquisition where you're paying for a brand, or you're paying for an intangible asset, might be a patent or something like that, where it's not like inventory or a piece of equipment that you can go out and touch. It's something that provides value, but you can't touch it. This is important because there's an ability to write these assets down, where if maybe the brand, or if you purchased another company, isn't as good as you expected, there's a possibility to write that down, and that again can, because this is an asset, can impair the balance sheet. So it's just something to pay attention to, and that really takes us down to the asset part of it. Next, we'll go to liabilities, and again, we're going to look at common size. So these are your short-term borrowings. And what's interesting here is there was very, very little borrowing, at least in the short term here. And then you had a very large borrowing in 2019 in the short term. That can be a number of different things, but again, something you may want to look at. Here's your accounts payable. So this is what you're paying to again, this is probably something to do with their inventory. So they pay people, they put inventory in the store, and then they have to sell it. That's been pretty consistent over time. It started to go up and then has dropped in 2020. These are accrued expenses and other liabilities, and those actually, you can see the trend there is to drop over time, and then income taxes, as a percent of liability, those have actually dropped over time. And then again, here you can see the operating lease, that is just come in 2020. Something happened with Walgreens where they sold some of their buildings and then converted them to operating leases. And then here we'll go, this is long-term debt. This is important because, again, long-term debt is, whether it's long-term or short-term, debt is something that needs to get paid back, and you're paying some type of interest for that. And so what's interesting here is, that long-term debt really jumped up in 2016, and then is paid down is actually only about 18%. So that's actually an encouraging figure to see the long-term debt drop. What's interesting here is, and again, I'm going to bring you back, this is 44% in 2016. I said something happened in 2016 because if you go up here, you can see the cash level is high. So most likely, the reason why cash was high is they probably did a big bond offering in 2016, which is why long-term debt was higher. Most likely that was the case. Here's your deferred income taxes. So Again, this is not too important for here. And then other non-current liabilities, those are dropping as well. For this review, again, we're not going to pay too much attention to it. Then the last part of the balance sheet is the equity part. And I'm not going to focus too much on this, but what you want, the reason why they call it a balance sheet is because liabilities and equity has to equal, as you can see here, 87,174. That needs to equal assets, which assets are 87,174. It's a balance sheet. It balances out. And so as we go to equity, one of the things that's important is, and again, we're not going to do common size on this one, but we're going to look at a growth rate. And this is retained earnings. The reason why retained earnings is important is because it's basically calculated from net income minus dividends paid plus your beginning retained earnings. So if you look at the growth rate of retained earnings, that gives you a good understanding of the health of this company because, again, it's the net income minus dividends. Dividends are a return to shareholders. So it was actually 15, 16 was fairly consistent, 12%, 10%, but it has slowly dropped, and then obviously you can see there was a negative in 2020. Again, because of the year, what we want to see is in 2021, this figure start to bounce back up. The last part of this is again, different ratios that you can use outside of just common size. We're going to have an entire video talking about ratios, but this one, again, is just on the balance sheet. So one of the things here is the quick ratio, which is basically looking at how much cash really there is, or cash and short-term assets there are to pay off your liabilities. Obviously, you want to see a higher number is better, but you want to look at the trend. And again, here too, you can see 2016 when they raised that debt, that was almost near 1, which is very, very good. And then it's trended down to 0.32. Not alarming, but you don't want to necessarily see this trend continue to happen. Next, you want to look at long-term debt to equity to see how much, how much of the capital structure is being used on debt. So very, very small in 2014, 0.63, that's the high with the debt issuance in 2016, and you can see it's around 50% and then spiked up again a little bit here in 2020. Then short-term debt, what's interesting here is, whether it's long-term or short-term, you can see they didn't use much of it. And then in 2019 and 2020, they used a lot more short-term debt as opposed to long-term debt. Again, why is that? Something you would have to go and look at the management discussion or conference calls. There's probably a reason why they started using more short-term debt than long-term debt. And then you compare it to, not only to equity, but then total liabilities. And that actually is a little bit more consistent. Spikes again for long-term and then drops down. And you can see here it's a little bit more consistent for short-term. It drops and then spikes higher in 2019, but stays a little bit lower there. And then lastly, it's total liabilities to assets. Again, this trend here is a little bit worrisome because your liabilities to your assets, if something were to happen and you needed to sell your assets to take care of your liabilities, you don't want to have more liabilities than assets, right? Because in that case, if you have a bankruptcy and you have to sell everything, then you're not going to get as much money back. So what's interesting here is it was very, very low in 2014 and has trended higher to 0.76 in 2020. So that overall is the balance sheet review.